Hello, everybody. Welcome. Thanks very much for joining us for Gifting and Charitable Strategies. Today, we're going to talk about how to approach gifting, annuities, donor advised funds. We're going to be doing a deep dive into donor advised funds and other vehicles to meet your client goals. And I'm Dan Broccoli. I'm head of content here at Vanilla. Just so you know, for all of you attending, we've also got a new updated gifting guide that we're going to be sending out to you that's going to reference a lot of the concepts that Patrick and Dan talk about today. So be on the lookout in your email for that because it's a great reference for a lot of these, the funds and trusts that we're going to take into consideration today. And there you'll see a Q&A form here on our Zoom. Please, by all means, drop in your questions as we go. We're going to have some time at the end to cover those questions. We may be able to get to a few during the talk, but we're going to reserve time at the end for sure to get to those. So please, by all means, drop those in. And I am very excited to have two terrific panelists today. We've got Patrick Carlson, who's a Vanilla product counsel, and he serves as product counsel here at Vanilla. He works closely with the product design and engineering team to build additional functionality into Vanilla. And before joining Vanilla, Patrick worked at an 8 billion AUM RIA, leading a financial planning, estate strategy, and tax team. And he served the firm's high net worth clients. Patrick received his JD from the University of Oklahoma in 2009 and his LLM in tax from the University of Florida in 2010. And he resides in North Carolina. So welcome, Patrick. And very excited to have a guest, Daniel Blake, here from UI Charitable Advisors. He's a CEO of UI Charitable Advisors, and he spearheads initiatives that help donors achieve their philanthropic goals. And he also mentors the next generation of social impact leaders. And previously, he was the CEO and co-founder of EcoScraps, which was acquired by Scotts Miracle-Gro. He has led sustainability initiatives with the U.S. State Department, United Nations World Food Program, Amazon, Google, Home Depot, Walmart, and some of the world's largest food companies. So this is pretty impressive to have him here. He was named one of the top social impact entrepreneurs in the USA by Bloomberg Business Week, and he's featured on the cover story of both Inc. and Forbes. So really terrific to have both of these experts on today. Welcome, Patrick and Daniel. I'm going to turn it over to you to talk through some of these gifting and charitable concepts. Thanks very much.
Thanks, Dan. All right, so let's go ahead and jump in here to sort of a high level kind of what we're going to cover today. We're going to start with some of the reasons that clients consider charity. We're going to talk a little bit about some of the benefits to your practice. Then we're going to go through kind of a survey of some charitable options and then also some non-charitable giving options that can obviously help on that estate planning side. So we're going to cover a range of things from direct giving to donor advised funds, from complex trust to private foundations, and then some comparisons. So that way you're armed with some great information for year-end planning as we're approaching that time of year. Again, some of the reasons that clients think about incorporating charitable planning. I mean, first and foremost, it's because they have a cause that they care about. They have a reason to give. They have some type of organization or something that they're wanting to benefit. Of course, Congress has written the laws, as have the states written the laws to incentivize this type of behavior with a lot of income tax. And then again, for our ultra high net worth and high net worth clients, there's estate and gift tax benefits as well associated with giving. And then finally, some of our charitable tools that we'll talk about today allow you to achieve kind of multiple objectives. Like maybe there's some ability to kind of split things between a charity and the family. It's a way to pass along sort of some legacy goals and have a way to kind of pass along some of those family values and put some purpose behind it and some structure around it. So a couple of different reasons that your clients are often considering these things. But again, it's not just about the clients here. There's also some benefits to your practice as well. So Dan, anything that you would kind of share here about some of the kind of benefits to your practice associated with charitable giving?
Yeah, absolutely. These stats come from a benchmarking study looking at 1,200 independent RIAs and family offices, looking at those that included charitable planning in their offering versus those that didn't. And I just think these stats are really compelling as to why you should include charitable planning in your service offering. Those that did include charitable planning saw 6 times the median assets, 3 times the amount of organic growth, and perhaps the most compelling, when the client was asked the question, do you view your advisor as a multi-generational resource to your family? Those that included charitable planning scored 27% higher. And given the amount of wealth that's transferring from one generation to the next, I think this is just an incredibly compelling business case as to why charitable planning really matters.
Yeah, absolutely. Gives you that chance to kind of also seamlessly kind of integrate it into the practice as well. When you're talking about that multi-generational planning, always looking for opportunities to do that.
Absolutely.
All right, so let's kind of go over our high-level overview of some of the charitable strategies here. We're going to kind of cover these roughly in this order. We've kind of grouped them here based on sort of some of the from simplest to most complex. And then, we'll kind of go into each one of these in some level of detail. But what I want to do now is just kind of jump in and talk about our first one, which is, direct gifting. Now, this is clients love this one because it's super easy, right? It's just pulling out the checkbook, writing a check, or clicking the button in an email to give now or donate now. Um, but the benefits can sometimes be limited. There's no continuing impact. There's no ability to sort of have further direction or say or input in how things are kind of going. Again, sometimes I saw this where people are maybe donating an old car or truck. They're donating maybe appreciated securities, but to be honest, mostly what I see here is people giving cash, which is one of our less desirable options because we're leaving a lot of tax benefits on the table. So direct gifting, you see it out there. It probably shouldn't be our go-to type of planning. It's just one of the ones that sometimes clients will ask about. So you need to be aware of it, but definitely not one of the go-to options, especially for larger types of gifts or planned type of giving. Now, one of the next options we look at sometimes is called a QCD, or a qualified charitable distribution. Now, this is one that I actually really like for clients that are eligible for it. So let's talk a little bit about the eligibility. Your clients are eligible to do this if they are age 70 and a half or older, and they are making distributions of up to $100,000 from a traditional IRA account. Now, many of you are probably thinking 70 and a half, Patrick. Didn't they change those ages? Well, yes, they did. They changed the RMD age, or the required minimum distribution age. Secure 2.0 is gradually phasing that up, but Secure 2.0 did not touch the 70 and a half age for QCDs. So we are still able to make those, or your clients are still able to make those at age 70 and a half. Now, what's great about QCDs is that although they are still a form of direct gift in my mind, because you got to make them, outright to those charities, they are particularly income tax advantaged because for clients that have RMD exposure, the QCD can qualify since it's up to $100,000 per year. If their RMD is less than $100,000, they might be able to use the entire required minimum distribution, which can save a lot on income taxes, can help with Medicare adjustments and other sort of threshold taxes. So this can be a really great giving option. It also dovetails nicely for estate planning purposes because traditional IRAs are not the most advantageous asset to inherit for children or other non-charitable beneficiaries. So a QCD should definitely be on the list, especially as we're looking to kind of wrap up any RMDs for any clients that are age 70 and a half. All right, so Dan, I'm going to hand it kind of over to you so we can talk a little bit about some of the options that continue with sort of longer term types of impact, increase the complexity a little bit, but really start hitting a lot more of those client goals that many people are after.
Yeah, so one of the most common options, especially for higher net worth individuals, is going to be a private foundation. Um, the benefit of a private foundation is you receive an immediate tax deduction when you make the contribution to the private foundation. Uh, Private foundations, you can then issue grants to various nonprofits or social ventures over time out of the private foundation. And the power here is you're separating out the timing of your tax deduction from the timing of your giving. One thing to note with a private foundation is there is a required minimum distribution which is 5% of the total assets that are held in the foundation, need to be given out to charitable organizations every single year. If we jump down to the next slide, an alternative to private foundations would be a donor advised fund. And donor advised funds are currently the fastest growing charitable tool that's out there right now. And so the concept is very similar. A donor contributes to a donor advised fund. They receive an immediate tax deduction. And then over time, they can grant out of the DAF to, again, nonprofits or social ventures. If we jump down one more slide, what's interesting here is donor advised funds and private foundations functionally are essentially the exact same. You as the donor, you donate, you contribute to either the donor advised fund or the private foundation. You receive a tax deduction at the time of that contribution. And then again, you can then grant out of the donor advised fund or the private foundation over time. So conceptually, these two things are basically identical. When we get into the details, you're going to see that they actually differ quite a bit. So we have a couple of slides that go through a comparison of donor advised funds compared to private foundations. And we've broken this out looking at 6 or 7 different considerations that you'd want to consider when you're looking at a DAF versus a private foundation. And the first one is just the complexity around setting up the instrument. With a donor advised fund, you can set it up essentially immediately. It's through an existing public charity, so you're not having to file any new paperwork to create the donor advised fund. All donor advised funds charge a DAF admin fee, which is generally a very low admin fee, and there generally are no startup costs. Whereas with a private foundation, it's its own separate entity. So you're having to file to create that entity. You then have to wait for the IRS to approve the private foundation. Generally, we see most people setting up private foundations when it's tens of millions of dollars just to justify the startup expenses associated with the private foundation. In the case of donor advised funds, we will see DAFs that are as small as $5,000. The next one would be the causes that you can support. Both DAFs and private foundations can support domestic and international nonprofits. Both are able to make impact investments. And so that would be contributions, whether that's a grant, a recoverable grant, a direct loan, a direct equity investment into social ventures. The biggest point of difference between donor advised funds and private foundations is that donor advised funds have to fund another entity. They cannot send funds directly to an individual. Whereas a private foundation, you are able to send grants to individuals. Practically, where that plays out is in the form of a scholarship. If you want to run a scholarship program, you can do that through a private foundation. You wouldn't be able to do that through a DAF. A DAF is able to partner with scholarship programs, which are often held at schools and universities, and can help fund the scholarship program, but the DAF wouldn't be able to operate the scholarship program. If we jump down to the next slide, the tax benefits. So this is the biggest point of difference, and this is really the reason why we see most people opting for donor advised funds versus a private foundation. Cash donations. In a donor advised fund, you have a 60% AGI limit. In a private foundation, it's half that, 30%. Short-term capital gains in a DAF, it's 50%, whereas in a private foundation, it's only 30%. Long-term capital gains, it's a 30% AGI limit and a 20% limit in private foundations. The real kicker here is in a DAF, all securities, the tax deduction is based off of the fair market value. Whereas in a private foundation, it's only publicly traded securities that receive the fair market value. All non-public securities, so if this is real estate, this is private business interest, those are valued at the cost basis. There is no no benefit of appreciation of those assets if they go into a private foundation. So just across the board, a donor advised fund is far more tax efficient than a private foundation. We jump down. So 3 additional points that I think are really important and should be considered is the succession plan. Both DAFs and private foundations can have succession plans. In a private foundation, again, because it's its own independent entity, that succession plan has to be confirmed by the board of that private foundation. Whereas in a donor advised fund, it's as easy as updating a form on the online portal that most staffs are going to have. Distributions, I already mentioned that private foundations have a 5% required minimum distribution amount per year. There is no required distribution out of a donor advised fund. So there's some additional flexibility there. And depending on the donor, the role that they play in the community, they may or may not want to be anonymous. That's only possible through a donor advised funds. You can make a grant to an organization and remain anonymous through a donor advised fund, whereas all grants out of a private foundation are made public. So depending on the desire of the donor, that may or not, that might be more or less important. So hopefully this comparison, you can see, even though structurally DAFs and private foundations look almost identical, when you get into the details, there actually are quite a few differences. If we jump down, so here's one just practical strategy to help illustrate the power of separating out the timing of the tax deduction from the timing of your giving. So this strategy, we call it charitable bunching. You're essentially taking multiple years of charitable giving and front loading it into a single year. So let's assume you are working with a married couple and they pretty consistently are giving $15,000 a year to several different charities. This might be the church that they attend, the university that they attend, the local Boys and Girls Club, the local soup kitchen. There are all sorts of different charities that they could be supporting. And so when they're filing their taxes, we're going to assume donations to charities, $15,000. State and local taxes, $10,000, mortgage interest, $6,000. So their total yearly itemized deductions, $31,000. The standard deductions, $27,700. So that additional deductions just slightly larger, $3,300. So if they're doing this every single year, we're going to look at it over a 5-year time period. The total donations that they're making to charities over that 5-year period is $75,000. Given that they're itemizing the deduction, the total tax deduction over that same 5-year period is $155,000. So this is without charitable bunching. And this is what most people do, which just isn't very tax efficient. But if we now change the timing, and if we jump down a slide, so the only assumption that we're going to change is the timing of their giving. So with charitable bunching, they're going to move the full $75,000 that they give into that first year. And so their total itemized deduction now increases to $91,000. And so the donor is receiving a significantly larger tax deduction in that 1 year. If we jump down a slide, in the subsequent years, 2 through 5, they're just going to claim the standard deduction at $27,700. It's really just some tax deduction arbitrage here. So in years 2 through 5, that tax deduction is just over $110,000. So in this second scenario with charitable bunching, the total donations over the 5-year period remains at $75,000. But now all of a sudden, that total tax deduction has increased to just over $200,000. And if we jump down a slide and look at the comparison, by just changing the timing of their giving, without charitable bunching, the total tax savings over the standard deduction is just over $16,000. And by changing the timing of their giving with charitable bunching, you're able to increase that to just over $63,000. So it's 3 times the tax savings over that 5-year period by simply changing the timing of their giving. And that's really the power of a donor advised fund or a private foundation, in separating out these two transactions, the timing of the tax deduction from the timing of your charitable giving. And by separating those out, you can optimize for both, which really does lead to pretty powerful tax savings.
And Dan, the thing I would add here also is, we're mid-October right now as we're sitting here, and we're rapidly approaching the end of the year. Um, if you're trying to make these charitable decisions, like on the deduction as well as who's going to receive the money, and you're trying to make that like in the week between Christmas and New Year's, the chance of your mistakes just goes up a lot. So the other advantage of this bunching is it lets you do you can make this donor advised fund contribution at a time like right now. Maybe you just filed because you were on extension. You can say, gosh, I don't want to have such a large bill next year. Let's get this taken care of. And then the when you actually distribute that money to the ultimate charities can be kind of completely decoupled from the tax decision. So you avoid some of that kind of year-end rush that also can result in some mistakes or what have you. So that's the other reason I really like it too.
Exactly.
All right.
So I'll turn this back over to you, Patrick, to jump into some of these more complicated vehicles.
Perfect. Yeah. So the donor advised fund and private foundation and direct gifting and QCDs are all about just only benefiting the charity. So some of the things we're going to talk about in the rest of our charitable section here are sort of mixing the benefits, where we're going to benefit the charity some. Maybe we're going to reserve a little bit for ourselves. Maybe we're going to provide income or some benefit for a non-charitable beneficiary. So these are much more complicated tools, but it's that sort of final pillar of client goals that we talked about at the beginning, which are those types of client goals where we have multiple things at stake. Maybe we have a really low basis asset and we want to liquidate it, but we want to manage some of our tax exposure. We also need to generate some income for ourselves or for a loved one. So that's where some of these strategies kind of factor in and play in. So when it comes to a charitable gift annuity, the idea here is that we're still making a charitable contribution to some type of charity, but instead of saying that they get all of the money, we're going to receive back some annuity income. And then the charity is going to receive whatever is left over at the end. So the idea here is these can work when we have that goal of needing to perhaps generate some income for ourselves, but we still want to have some charitable intent. Now, these are a lot less flexible than charitable remainder trusts, which is the next strategy we're going to talk about. But sometimes they're used instead of those charitable remainder trusts, either because the amount that we can reasonably set aside or our clients are setting aside is smaller than what might justify a charitable remainder trust, or maybe the client can't handle or doesn't want to deal with the complexity of a charitable remainder trust, and they're willing to forego some of the flexibility that option might provide. So charitable gift annuity is definitely an option for people who are looking to kind of split those benefits between themselves and a charity. But, again, the one that we see sometimes is also a charitable remainder trust. Now, these are irrevocable trusts. So these are not changeable. You've got to be committed to the plan. Client has to be committed to it. The way it fundamentally works is that there's a non-charitable person, which can either be the donor or maybe a member of the donor's family, like a child, a grandchild, whoever it might be. They receive payments either for life or for a term of years. Then, when that life is over or when the term of years is over, the charity receives whatever happens to be left in the trust. So this essentially splits things across time. You get the tax deduction for income tax purposes today. From an estate tax standpoint, it's removed from your estate. So this can be good from multiple different tax lenses. But again, it is an irrevocable trust. So now we have to think about all of the things that trust-based planning entails. We've got to pick a trustee. We're going to be filing a tax return. There's records to keep. There's investments to manage. So there's a lot more complexity with this. This is a lot more like that private foundation. So it's not exactly like a private foundation, but it's similar to that in the sense that we have a lot of sort of compliance and other considerations to make. Now, some flexibility tips that we can do here. We can actually we can have, instead of picking the charity at the beginning, because remember this is an irrevocable trust, so not really changeable. But one flexibility point we can have is we can have that amount that goes to charity at the end pay to a donor advised fund or pay to a private foundation. So there's still a way to merge this with some of those other tools and still get some flexibility there. Now, there's two flavors of charitable remainder trust, two predominant flavors that you'll hear about. One of them is called a CRUT, or a charitable remainder unit trust. The other is called a CRAT, which is a charitable remainder annuity trust. The way they're different is how that payment or income stream back to the donor or other beneficiary is calculated. The unit trust takes a fixed percentage of the assets every year. So call it 5%, let's say. And the way it works is the trustee values the assets each and every year and just pays out that percentage. So the dollar amount will float up or down depending on the investment performance of the trust. The charitable remainder annuity trust is a different calculation. What it does is it determines a dollar amount that is going to be received, and then the trustee just pays out that dollar amount every year, kind of regardless of the investment performance. Now, one risk that some clients should be aware of when they're considering using a charitable remainder unit, a charitable remainder trust, either annuity or unit trust version, is that this is one of those trusts where maybe the family gets a lot less benefit and the charity receives more benefit than was expected. That can happen if you're using a term of years. So it's based on, say, the client's life. They're the donor, they're receiving back that income stream. If they die prematurely, it's possible that we are leaving a larger than expected amount of wealth to the charity than what we were expecting based on kind of the life expectancies. So, because remember, that charity is going to receive whatever's left over. So if you do that trust and the client dies 2 years later, charity is going to have a relatively good deal. The family, of course, does not receive any of that wealth. So sometimes you also need to be thinking about making sure that this is overall from the big picture, kind of hitting the overall needs of the family as well. So now let's talk about the kind of flip side flavor, which is a charitable lead trust. So a charitable lead trust is another irrevocable trust that can be used to kind of split the benefits between charity and non-charity or people. The idea here, though, is that charity receives that income first. So the idea here is that we're going to set this up. We're going to put some money in. The charity receives the income at the beginning, and then at the end of that charitable term, then whatever is left over is going to pass either back to the donor, in which case we call that a reversionary charitable lead trust, or it's going to pass to other beneficiaries, and that might be called a non-reversionary charitable lead trust. There's a lot of complexity in this tool from an income tax standpoint, because if it's a grantor trust version, we have kind of one set of rules. If it's a non-grantor trust, we have a different set of rules, and you can pick between those. They have different purposes, different client profiles that they might make sense for. And also, just like our charitable remainder trusts, we have those same two flavors here. We have charitable lead unit trusts and we have charitable lead annuity trusts, with the exact same kind of delineation of how that charitable percentage or dollar amount is calculated each year. Now, from a general standpoint of what I have seen out in my personal career, when I saw these, I generally saw charitable lead annuity trusts. So usually when we're doing the charitable lead flavor, people want that charity amount calculated as an annuity, because it lets more of the upside essentially come to family. Because if you can beat the hurdle rate that's used to calculate that annuity, then we're passing relatively more wealth to family members, or we're getting that wealth back at the end. Whereas with the charitable remainder trusts, I usually saw charitable remainder unit trusts more frequently, because the idea there is that you want to be able to participate, have the family members who, remember, are receiving the income in a charitable remainder trust receive some of that upside over time, especially if it's a life, over a 20 or 30-year period. That annuity payment is going to be significantly eroded by the time we get out that far, just from a kind of cost of living type of standpoint. All right, so Dan, I'm going to hand it back to you here for us to walk through kind of another example of how these things kind of fit together to really kind of help clients with a particular type of transaction they may be running into.
Yeah, absolutely. Thank you, Patrick. So the second strategy that we want to look at, and again, the goal here is just to make it as practical as possible for you, is the gifting of private business or some private asset. And so why donate a business prior to sale? And again, we're going to be looking at how much the timing of the donation matters. And what we're going to be hitting on is by changing the timing, doing it before the sale, you're able to avoid capital gains on the portion that's donated. In addition to that, you qualify for a personal tax deduction. So let's jump into this. If we go down to the next slide, we'll set up this case study. Let's assume you're working with a family. They're currently charitably active. They want to continue to be charitably active in retirement, and they're selling their debt-free business for $10 million. So this is a private asset that they have. We're going to assume that their taxes include 20% capital gains, 7% state tax for a total of 27%. And you, as their financial advisor, you suggest, understanding their full financial picture, that they donate $2 million of the equity into their donor advised fund to help accomplish their philanthropic goals. So if we jump down to this next slide, we're going to look at two scenarios. What happens if they donate after the sale? And this is what most people do, versus if they donate before the sale. So going through this first scenario, making the donation after the sale. So this is going to be a donation of cash. So you have the sale price of $10 million. They're making no donation prior to the sale. They have a cost basis, we're going to assume, of $100,000. They were entrepreneurs. They started the business, so a very low cost basis. But so the taxable amount here is $9.9 million. They're going to pay $2.6 million in taxes. So the after-tax equities, $7.3 million. At this point, what most people do is they donate $2 million in cash to their donor advised fund, their private foundation, or various different charities. So now their final equity is $5.3 million. They qualify for that gift tax deduction based off of that $2 million donation. And if we assume that they're in a relatively high tax bracket, we're going to assume 44%. The income tax savings there is just under $900,000. So in this scenario, the final equity plus the tax savings is valued at $6.2 million. Now let's look at if we just change the timing of the donation. So again, we have the sale price of $10 million, but now instead of donating cash, they're going to move $2 million of equity in the business into a donor advised fund. And so UI Charitable or a similar firm would help put together a gift agreement that transfers the ownership from their personal ownership into the asset being owned by the donor advised fund. They still have this cost basis of $100,000, but now the taxable amount has decreased from 9.9 million to 7.9 million because that 2 million that's sitting in the donor advised fund isn't subject to capital gains. So now the tax is decreased from 2.6 to $2.1 million. Their after-tax equity is significantly lower because they've already made the gift. So it's $5.8 million. And at this point, they're making no additional contributions of cash into the donor advised fund or any charity. And when the business sells, that $10 million, a portion of it's going to go to the family, to the individual owners. And then that $2 million of equity that was held in the donor advised fund, it's at the point of sale that equity is turned into cash. So after they sell the business, the DAF is now sitting with $2 million in cash. So the final equity for going through the scenarios increased from 5.3 million to 5.8 million. And they still qualify for that gift tax deduction of $2 million valued at just under 900,000. So the final equity plus the tax savings in the scenario where you make the donation prior to the sale is the $6.7 million, just over $500,000 greater by simply changing the timing of the gift. And again, hopefully this helps illustrate, along with the charitable bunching scenario, just how powerful it is when you can truly optimize for the tax efficiency of the giving of your clients. And that's really where you are bringing a tremendous amount of value to your clients.
Absolutely. I think one of the things that both of the examples show is that proactivity is so important when it comes to maximizing the tax benefits when you have a client that has that charitable intent, because often waiting is the thing that results in a suboptimal outcome. Because if there's time to get something in place, then you're able to achieve some of these benefits. If you wait too long, you can still get some benefit, but you're really leaving here, example, $500,000 on the table. And I think most clients would absolutely grab that benefit if they certainly could, while still benefiting the causes they care about.
Absolutely. I couldn't agree more.
So, one thing that we think about as we kind of think about those examples and all the different kinds of strategies that we've walked through are sort of matching these different things to different types of client goals. Again, there's a lot of different choices here, but there are a couple of call them some rules of thumb that you can use. So, when you're listening to your client kind of talk about the sort of thread of control, if you will. So, a client who wants to make sure that they or their family members have the ability to have kind of continued input or continued decision making. That really leans a lot more towards like your donor advised funds, or maybe a private foundation if they're an ultra high net worth family. If they don't care as much about control, or the gift amounts are smaller, maybe those just direct gifting or QCDs are also appropriate. It's also kind of important to think about how much type of wealth we're setting aside. As Dan mentioned earlier, the difference in treatment for closely held types of businesses might be a deciding factor, where we're able to get a better treatment with a donor advised fund than we are with a private foundation. Um, the other thing too is thinking about the sort of multiple goals. So if we have a need to generate some cash, maybe our business sale example before, maybe the client is looking at selling this and wants to sort of generate some income stream for themselves or some family. Maybe even splitting that between a charitable remainder trust and a donor advised fund contribution, or a taxable sale combined with that donor advised fund, which is the example we walked through. Sometimes these things can kind of be merged together to achieve these different client goals. The key is just to kind of understand your client, and then run the numbers, and then pair it up with the strategy that makes the most sense for their situation. So I want to talk a little bit here about some other kind of comparison points across sort of all the different strategies we've talked about. So when it comes to things like the benefits to the donor, we've talked a lot about the income tax benefits. I want to briefly touch here also on some of those gift and estate tax benefits, because that's an equally important thing, or very important for our high net worth, ultra high net worth, or even for clients that aren't quite at those levels, but that live in a jurisdiction like Oregon or Massachusetts, where there's a state level estate tax. So again, all of our options here are reducing the size of our taxable estate. Our outright giving, our donor advised funds, our private foundations, they're reducing that taxable estate on the gift and estate tax side dollar for dollar. Again, clients here are generally needing to itemize. The only exception on that is QCDs. You don't have to get the tax benefit of a QCD. You don't have to itemize. So that one is also unique for a client that maybe otherwise doesn't itemize and they're otherwise eligible. QCD can be a really great fit for them. Now, again, when it comes to charitable remainder trusts, charitable lead trusts, it's a lot more complicated, the deduction. Again, accountants are going to handle that, but just know that that's something that's quite a bit more involved. So if a client has had sort of one level of tax prep complexity, and then they introduce one of these, expect an increased complexity, certainly for the year of implementation, and perhaps continuing into the future as well. Now, again, when we think about involving future generations and transitioning that wealth around, again, outright or QCDs, there's really no involvement of the future generation. So when we have clients that want to have that involvement, that legacy planning, we're definitely looking at donor advised funds or private foundations. These are both tools are obviously effective at transitioning wealth to charities, but when we want that continued impact, that ability to have continued decision making and involvement of future generations potentially, we've got to be looking at donor advised funds or private foundations. Now, when it comes to those charitable gift annuities, charitable remainder trusts, charitable lead trusts, again, the idea there is more about kind of what level of split of a given amount of wealth do we want to have between family and charity, and we're sort of using those tools to help us achieve that split, or perhaps generate income for the donor. So those are less about purely transitioning a given amount of wealth to charity, and more about really helping to achieve that other type of goal. And they don't really involve as much involvement of future generations. So another important point to think about when you're trying to match the exact strategy to your client's needs. And then finally, compliance, always something that is everyone's favorite topic, not really, but something we should always be thinking about here. Again, outright and QCD types of things, we don't really have any ongoing control, but there's also very little administrative or really no administrative burden. Once you've made the gift or made the distribution, it's over. You only have to worry about the initial income tax deduction filing. So those are as simple gets. Obviously, as we move down the chart, things increase. The donor advised fund is a really, really great sweet spot here because we have pretty easy initial deduction. The only thing you have to do, or your clients have to do going forward, is make those grant decisions and the impact investing decisions that Dan talked about earlier. And again, we have a lot of choice when it comes to that investment decision as well, with most of the donor advised fund providers. Again, private foundations, they just ratchet up that complexity. Every single year, there's an annual filing. It's for the federal, many states require a filing. It's a complex form, and it's a public form. So you lose that anonymity. Those forms are searchable. They can be found. Again, clients also have to deal with grant decisions plus potentially operational matters. So private foundation just really ratchets up that complexity. They can work for some types of clients, generally your ultra high net worth, but for the most part, the donor advised fund tends to win out on the compliance side of things as well. And again, our charitable remainder trust, charitable lead trusts, again, those have their own income tax returns that have to be filed. You have to pick a trustee who's going to be managing those. You generally want that to be a third party, just because you don't want your clients running the risk of running afoul of those things with all of the negative consequences that can happen there. So although the trustee is handling that burden, client has to pick the trustee, so it imposes some decision making there. And again, investments are generally controlled by that trustee as well. So that ends up being a really, really critical and important decision, and one that sometimes can be, although trustees can be changed, there's often, cost and complexity involved with changing those. So that trustee decision ends up being really, really important. You get a lot more administrative flexibility with some of our other tools. All right, so that kind of wraps up where we were with some of our charitable gifting, which is great because we get a lot of estate tax benefits, a lot of income tax benefits, ways to achieve some other client goals related to philanthropy. But we also wanted to talk a little bit about some non-charitable gifting, which again is a lot more focused on sort of estate and gift tax planning, but definitely something that we wanted to kind of walk through. Now, why are clients doing non-charitable gifting? I mean, they're not getting an income tax deduction for it, so why are they doing it? Well, typically it's being done to reduce the estate for estate tax purposes. So there's usually no income tax benefit or no material income tax benefit to any of these, but it's really about benefiting that family. And again, this is a good time of year to be kind of thinking about it, because some of these things are use it or lose it. If you don't use that annual exclusion by December 31st, then the 2024 one is forever gone. You can't go back and reuse it in 2025. We'll get a fresh set in 2025, but 2024's was use it or lose it. So, all right, let's talk about some of the options that we'll kind of go through here. First one, again, is that annual federal gift tax exclusion. We'll talk about kind of the lifetime exemption that everybody has as well, a special rule that's available for qualified medical and education expenses, and then finally 529 plans and some of the unique benefits that they have for the right to have a client. So our annual federal gift exclusion, think about this as a coupon that you get January 1st of every year. Every single person gets a coupon to give $18,000 to every person they want to. Up to $18,000 is the number we have this year. It adjusts from time to time for inflation. Spouses can do what's called a gift splitting by doubling that amount, so you can go up to $36,000 per person. It's per recipient. So if you have or your client has 15 grandchildren, they can do 15 times 18,000 or 15 times 36,000 for each grandchild if they're doing gift splitting. And this is done without triggering a gift tax. So don't have to file anything, don't have to pay any gift taxes, don't have to You don't have to worry about that at all. It's a great way to thin down an estate or reduce the growth of an estate, benefit some family, pass wealth along. It can also be used in some cases with some strategies like an irrevocable life insurance trust to help fund the premium payments to basically support that trust structure. Now, again, these will reduce the size of your taxable estate for estate and gift tax purposes, but they don't do anything to your client's income tax returns. There's no tax deduction for giving money to grandkids or children, but we do get to take advantage of it from a gift and estate tax standpoint. Now, our lifetime gifting exemption, think of this as a coupon that we only get once a life. So we don't get this one renewed every year. As we use this one up, it just slowly kind of goes away and then we don't get any extra. So this is that amount where if we go over the annual exclusion amount, so that 18,000 annual exclusion, well, what if we give 19,000? What if we give 20,000? What if we give $1 million? In this case, we're eating into our lifetime exemption. Now, the lifetime exemption right now is $13,610,000 per person. So between a married couple, the husband has $13,610,000, wife has $13,610,000. And they can leave that amount free of a federal gift and estate tax to anyone they would like. So this is a really, really great planning option. We're nearing up under current law, at least. We're nearing up on the sunset, which is currently going to occur on December 31st, 2025. So this 13,610,000 will adjust to a new amount for 2025. It changes based on inflation. But then in 2026, under current law, it is going to cut in half. And again, this is another one of those use it or lose it. So if you have clients that haven't used this heightened exemption before the end of 2025, now is the time to start having those conversations. We're over a year out, but now is the time to start thinking about it and putting in some planning to take advantage of that. Because if 2026 rolls around and that sunset happens and they didn't use it, there's no way to go back and take advantage of it. So definitely something that should be on the conversation list with clients. Now, qualified educational and medical expenses. This is a really, really great exception to that $18,000 per year limit. When a donor makes payments directly to education or directly to medical care providers for qualified expenses, there is no limit to how much they can pay. So this is a really great way to pass along significant wealth and also benefit what is typically very needed or worthy causes for the family as well. And the other advantage of this is that we don't have to worry about generation skipping transfer tax for educational or medical expenses either. So if your client is a grandparent, we use that example, they have 15 grandkids, they could pay for the college tuition and expenses of all 15 of those grandchildren without having to worry about gift tax and without having to worry about generation skipping transfer tax. So this is a way that clients can definitely pay that forward and really help out their families in a very, very tax efficient way. Now, one important caveat to remember here is that reimbursement does not qualify. So a beneficiary of one of these gifts cannot have paid the medical expense and then be reimbursed by the donor. The donor has to pay it directly to that provider. So there are some paperwork things that have to be really carefully watched here. But for the right families, this unlimited exclusion for these qualified expenses can be a really great way to transfer wealth while also providing sort of meaningful benefits to those beneficiaries. And then 529 plans, of course, this is something that works across many wealth levels. 529 plan is a way to save for education expenses in the future. One thing that's nice about these is that you can make a 5-year election to what's called super funding to add up to 5 years of annual exclusion gifts at one time. So clients don't have to do that 18,000 each and every year. They can actually front load that gift, make that election, and then they're able to have that those assets in that 529 earlier, which obviously can help compared to having to make those investments over a 5-year period. The thing that some clients should think about here when it comes to 529s are, although they have that nice super funding benefit, for some families, it might be better to use the information we talked about on the prior slide. So it might be better to just skip 529s altogether and just plan to make those payments directly to educational institutions rather than being restricted to the $18,000 limit that might be available within the 529. So definitely just run the numbers. Sometimes it comes down to the number of kids, the plans for education, the overall wealth level of the family, whether it's being used for children or grandchildren. But it definitely 529s can be part of the picture, and that 5-year election allows clients similar to the kind of bunching that was talked about earlier, allows you to get more in there and take advantage of that timing benefit as well from an investment standpoint. So I want to hit a couple of key takeaways here from our overall presentation, and Dan, definitely feel free to add in anything that you would share as well here. But I think one thing that's so important is it's always important to align those client goals and needs with the strategy selection. Again, donor advised funds are super popular and for really, really good reason, but they are not always the right strategy. So you definitely want to run through the analysis and make sure that you've considered the client goals and making that recommendation. Now, in many cases, you're going to end up with donor advised fund, but in some cases, you might end up with private foundation. You might say QCDs or something we've got to do because of an income tax picture. Maybe a trust is the right option. So definitely kind of run through the logic and make sure you're hitting the right strategy. The other thing here is, the income tax benefits are always important, but for your high net worth and ultra high net worth families, definitely also consider those gift and estate tax benefits and make sure you highlight those to the client because it's just an added thing that may get kind of lost in the shuffle, but definitely something that they should be aware of. And then obviously you want to consider those succession issues, which is another reason why donor advised funds are so great because they're a great way to kind of involve the next generation potentially in a much more streamlined way than the work involved with a private foundation.
The only thing that I would add there is in looking at these options is looking at how different strategies compare together or different vehicles compare together. If you're dealing with a CLAT or a CRUT, using the donor advice fund or the private foundation to build in optionality so that you can change what charity you want to support. If you do decide that you want to go with a private foundation, we see a lot of private foundations that have a sister donor advised fund in conjunction with it to help simplify some of that reporting and ease the compliance burden of the private foundation. So I think it's just also really important to understand how these different vehicles can play alongside one another.
Yeah, absolutely. I love we sometimes call those things a strategy stack, right? Because you don't have to pick one. You can actually pick a couple of things that play nice together and kind of hit all the different client goals. And then it's just a matter of explaining those things and what the purpose of each is. And that ultimately is where you're creating a lot of value for your clients because they're feeling like they're getting a truly customized solution then that's tailored to their family. So
Absolutely.
um, Dan Broccoli, do we have any questions that we would like to go through before we do any kind of final announcements?
Yeah, we do. We've had a few questions come in on the Q&A that Dan has been good enough, as well as his colleague Sarah, to answer, but I don't think the whole audience is seeing them, so I'd love to address them publicly as well because they're good questions. Let's see here. In regards to putting 2 million in the DAF before sale of a business, how long beforehand should they consider moving to the DAF? And is the DAF considered sold when the business is sold? Dan, you want to take this one?
Yeah, it's a really great question. So the IRS has not given any guidance from a timing standpoint, but the guidance that they have given is it needs to be done before any definitive sales agreement has occurred. So the donation to the DAF needs to be an independent transaction from the sale of the business. And so practically speaking, what we see is that's weeks beforehand, maybe upwards of, 2 months before that transaction happens. Generally, we see that people will be in the due diligence stage for the sale of their business, but again, there can be no definitive sales agreement signed by the time you move the ownership from your personal ownership into the donor advised fund. And then with the second part of that question, yes, when the business sells, the DAF would sell right alongside all of the other owners and transfer that equity into cash so that it can start giving money away to various different charities.
Wonderful. Thanks so much, Dan. Another follow-up question about DAFs. Can Schwab or Fidelity DAF accounts hold private businesses before sale? It says we've used all of their strategies discussed, but we didn't know that was possible. And can you speak to that a little bit?
Generally, yes. It also depends. We have seen that Fidelity and Schwab really dislike S corporations. And S corporations really are the exception to the exception in the world of charitable deductions. We manage S corporations at UI Charitable. We actually donate them to a charitable trust prior to moving them into a donor advised fund because it's more tax efficient. But generally, yes, they do, but you are going to, want to share the specifics with them. Real estate can be more complicated, S corporations can be more complicated. And that's also the case with a lot of community foundations that host donor advice funds. Many have that capability, but it is going to be dependent on the specifics of what you are wanting to donate.
Great. And this is probably for both of you, actually. So what is the labor and expense involved in managing some of these various trusts or DAFs?
I'll take the DAF portion. It's really minimal on the part of the donor. It takes about 15 minutes to set up the donor advised fund. And that's really it. You then move into a role of just looking at what organizations do I want to support from a charitable standpoint. So from a DAF standpoint, it's pretty minimal. I will leave all the complicated ones to for Patrick to answer.
And I
Yeah,
guess also a follow-up, Patrick, on the expense there. At what point does a trust become logical? I mean, at what
yeah.
point, how large a gift is required before a trust makes sense?
Yeah, that's kind of where my mind was leaning to was I mean the complexity in like your charitable remainder or charitable lead trusts comes from the fact that you're going to need a trustee. Um, I've always seen it as a third party trustee. I mean, I think maybe technically the donor could be their own trustee, but I've never seen it, nor would I ever recommend it. So you're gonna have a trustee. So from just a kind of a cost standpoint, now again, from the donor standpoint, they're picking the trustee, so there's some diligence. They're gonna have to make a decision there. Trustee is going to need to then actually take the day-to-day running of the trust, choosing the investments, filing the tax returns. The donor is going to get an additional tax form in a charitable remainder trust. They're going to have sort of, if they're receiving that income for the rest of their life, they're going to have a permanent increase in the complexity of their tax return. So some people are opposed to that. Other people say, hey, I have a tax preparer. They're handling it. I don't care. But something that also has to be kind of thought about. When I think about the dollar amount piece here, just given the costs, and also trustees have their own business acceptance rules. So if we're looking at a third party or professional trustee, there's a lot of them that won't work with relatively smaller amounts of money. My rule of thumb is around $1 million. Now, again, there might be circumstances where we would go under that, but if we're not looking at least $1 million set aside for this charitable trust, we're probably looking at one of the other options. Maybe a charitable gift annuity if we still need some income. Maybe it's a donor advised fund and a taxable sale, like the example we went through, where we're generating, we're getting some tax deduction there. But unless we're doing at least $1 million in there, a charitable trust doesn't make a lot of sense.
That's a great rule of thumb. Okay, one final question. It says, we've been hearing a lot about premium finance from our insurance partners, asking our clients, who are board members of nonprofits, to engage in a premium financed life insurance policy in which the charity is the beneficiary. Any thoughts here? What should we be looking at?
Yeah, not I don't have a huge background in life insurance, so that'd be something I would have to kind of look into. We have another product counsel who is very experienced with life insurance, so I would have to get back on that one.
Fair enough. Appreciate that.
I will also say this can be a much more complicated strategy. We have seen it with various different charities that we work with. There's a lot of guidelines, a lot of compliance issues that you would want to consider in this case.
Great, thanks for that. And we do, oh, there are a couple of questions about getting the presentation. We will send this presentation as well as our gifting guide out to folks who attended, so not to worry there. Patrick and Dan, let's take us home with the last couple summary slides, if you will. So just a reminder, who Vanilla is, where Patrick and I come from. We're an estate advisory platform, along with an educational ecosystem and a lot of experts to help out. Our platform, what it does is it assesses estate plans. It allows you to visualize them. It allows you to do projections and scenario planning so that you can understand how each of these things work, how the trusts will work together. And we can also do, the platform also takes care of documents, so brand new documents as well. So it's the entire gamut of estate planning, specifically designed for advisors to help their clients. And it's really for every wealth level, right? So this is everything from your mass affluent all the way up to your ultra high net worth with more complex trust structures, which we've been built to accommodate. So that's just a very high level summary of what we do. Please do check us out at justvanilla.com. You can schedule a demo and get a kind of more hands-on view of our product. Thanks, Patrick. And I have to do a quick plug. If you liked this educational presentation, thank you so much, Patrick and Dan. We're going to have Vanilla Academy live at the end of the month on the 30th, where we have a couple more CE courses given by Steve Lokshin, our founder, as well as Jeffrey Levine from Kitses. Please, these are going to be great courses. We really value bringing education to you, so I hope you'll attend. And Dan.
And just to end, if you have any additional questions about donor advised funds, how they could fit into what you are offering your clients or specific cases, feel free to reach out. My email is danblake@uicharitable.org. Our website's uicharitable.org. We are, thrilled to be working alongside Vanilla and want to be a resource for all of you.
Thanks so much, Dan. Thanks so much, Patrick. Appreciate it. And until next time.
Thanks.
Thanks so much.